Good day, everybody. Let's get started. My name's Emmett Kilduff. I'm a co-founder here at the Fortia Group. Welcome to today's webinar, where we will focus on an interesting discussion regarding the results of our survey of aggregators, specifically around acquisition trends that we're seeing and they're seeing in the market. So the agenda for today, I'll give a 3-minute max overview of the Fortia Group, particularly for those that don't know us. I'll then briefly give an overview of the survey. The panelists will each introduce themselves, and then we'll go into the key highlights based on 5 sections of the survey. First, we'll discuss acquisition criteria. Then we'll go through highlights regarding deal flow, highlights regarding valuation and deal structures, performance post-acquisition, and finally, we'll spend hopefully at least 5 to 10 minutes talking about the predictions of the respondents to the survey and our panelists here today. Briefly, from a housekeeping perspective, please do submit questions via the Q&A button on Zoom as we go through the webinar. We will seek to answer your questions as we go through, not just leave them until the end. And a recording will be made available via the fortiagroup.com website in the coming days. So let's get started. First of all, I want to give you a brief overview of the Fortia Group. So in one sentence, what is the Fortia Group? It is an M&A firm focused exclusively on e-commerce exits. We're not doing equity raises or financing raises. It's purely on the M&A product, and its sole focus is e-commerce. We're not looking at SaaS businesses or other technology types of companies. It's purely e-commerce exits, which includes obviously Amazon FBAs, but increasingly we're looking to do deals from a DTC nature. For those that haven't seen the guide we published for FBAs, we published back in June a 70-page guide on how to do exits. We were delighted that nearly 25 aggregators contributed to this guide, as did successful sellers and influencers in the market. So particularly for the Amazon entrepreneurs on the call today, very useful guide as you begin to think about exiting your business. The Fortia Group, we started working on deals in May this year, and we're on track to advise on 30 mandates in our first full calendar year next year. An example of a recent deal is a supplements business, a gummy supplements business called BeLive. It's a US company, and we're exclusive strategic and financial advisor to BeLive. It actually ended up selling to a German private equity firm called Finex for consideration well into 8 figures. The valuation multiple was 5.75. So this is one of many deals that we're looking to do. We'll do exits all the way from $1 million to $100 million. In terms of our vision, we want to be the Morgan Stanley for e-commerce exits. As many of you, I'm sure, know, Morgan Stanley is the leading firm at M&A worldwide. I worked at Morgan Stanley in the corporate finance department out of the London office, and our vision is to be the Morgan Stanley for e-commerce exits. That's what we want to aspire to be. Okay, so let's move to section 2, overview of the survey, and we'll ask each of the panelists to introduce themselves in a moment. So I was at the conference in Berlin 2 or 3 weeks ago now, where it was called Pitch Day. Lots of aggregators pitched to brands and brands pitched to aggregators, and I spent time with 5 aggregators devising this survey. So the 23 questions have inputs from 5 of the leading aggregators. 38 aggregators completed the survey over the last 2 weeks, making it the most recent survey of its kind in the space. Importantly, it's anonymous, so none of the comments or submissions are attributed to any of the aggregators, either on this survey or in any further follow-up materials. The benefit for aggregators is that they get access to the underlying complete raw results, again on a redacted basis. So I'd like to now ask each of the panelists to introduce themselves. Please unmute yourselves, turn on your cameras, and I look forward to hearing your introductions.
Okay. Everybody, Ken Kubec, VP of Acquisitions at Thrasio. I, prior to Thrasio, spent probably over a decade in investment management as a equities analyst and portfolio manager, and then transitioned into the technology startup / Amazon world. I've been with the company for over 3 years, pretty much since the founding of the company. And at Thrasio, I think we're probably the largest Amazon aggregator globally. We've acquired over 150 brands, kind of company today. So thanks for having us.
Thank you, Ken. Arnau?
Hi, everybody. I'm Arnau. I'm an acquisition manager at Unybrands Group. I focus in sourcing and acquiring companies in Western Europe, the United Kingdom, and North America. I've been with the company for the last 4 years. Prior to being in the M&A team, I helped the firm rolling out our organic brands in the UK and the United States. And prior to being in e-commerce, I started my career in the Swiss banking industry.
Thank you. Brendan?
Hi, everyone. Thanks, Emmett and Fortia, for having us. I'm excited for the conversation. I'm the head of investments and integrations at Unybrands. I was one of the early employees here with our team. We're pretty equally spread between the United States and Europe on both sort of our deal structure and our team. And excited to have this conversation with this group here. My background is half M&A investment banking and half company building, I guess I would describe it, at WeWork, which I just realized today is going public this week, which is super exciting. We're all going to get the outcomes we all hoped for from that business.
Great. Thanks, Brendan. Trey?
Yeah, hey everyone. I'm Trey Cobb. I'm on the investment team at Upper 90. Prior to Upper 90, I was with Barings, focused on middle market private credit. At Upper 90, our core verticals are e-commerce and fintech. The primary goal is to help founders retain ownership with thoughtful early stage capital structures instead of rushing to raise what can be super dilutive equity rounds. We've been investors in the aggregator space since 2018 and have backed 13 to date. I'll just say it's really awesome to see how far the strategy has come. Like even just in the last year, it's so cool to see how far along everyone is. Just when most were only concepts in a pitch deck this time last year. So excited for this conversation.
Great. Thank you, Trey. And we are working on the video for panelists. Apologies for that. Okay, so let's move to section 3, acquisition criteria. So when we produced that exit guide back in June, we spoke with 25 different aggregators, and we asked them all what were their key checklists of acquisition criteria. And the chart on the left-hand side is a summary of that, and there's more content in that guide to build on each of these. As the first question in the survey over the last 2 weeks, we wanted to get a feeling for the priority of all these acquisition criteria. So we asked each of the respondents to rank each of the 9 items here, 1 through 9. And the results are on the right-hand side here, with sort of preferred category being the most key acquisition criteria. Second, revenue above a minimum threshold, typically of $1 million, although that seems to be rising. Third, net margins above a minimum threshold. What are people's thoughts? Maybe who'd like to kick off? Arnau?
Yeah, I'd like to discuss on this one, because I think working for BBG, I think we can relate to the first one, being preferred category. I know it might be surprising for some people attending this webinar because they have a vision of aggregators like doing buy and hold, but what we need to understand is that we are also product companies, and we're specialized in specific industries. So we're actually aggregating to build synergies and to create more scalable and profitable companies. So in fact, in most part of the times, the ones providing the guidance on basically how to source and identify the good companies are our product managers and brand managers. Basically, they understand, they're experts in their industry, they understand what technologies will be rolled out, what could be a good complement for our catalog. So actually, I'm not surprised that also other companies are thinking that way, right? Because if we have like lots of different categories and subcategories, then it's starting to become quite hard to create synergies. What is interesting, apart from the other ones, the second, third, fourth, and fifth being not surprising, is that selling primarily on Amazon comes sixth. That's a major change, because if we looked at this like a year ago, actually, like, Amazon was already like the most important criteria. If it didn't sell on Amazon, people won't consider the investment. So here also we're seeing this evolution on aggregators on moving also towards other marketplaces.
Thank you, Arnau. Brendan, any thoughts?
Yeah, I mean, that was a sort of great summary of how Berlin approaches it. And I think, we would agree with most of these criteria here. Ultimately, I think, within any category or meeting any of these criteria, I care most about quality and differentiation of the brand and product portfolio for the companies that we buy. The thing that I'll often say is, I want to be proud of the businesses that we own. And so I want it to be products that we use, products that people in our networks and ecosystems and our families use. And that's why we're always focused on categories that we understand well, and that we have passion around, which are usually, areas where you're spending either time kind of focused on yourself or your family or your pets or your kids. And those are things that we all understand well and have passion around. And so that's where, we feel like we can sort of give each brand the effort and focus and love that the founders do. Because if we sort of approach them any differently than the people who are running them before we own them, we're not going to be successful. So we just really need to care about the quality of the products and brands that we own.
Great. Thank you, Brendan. And just on housekeeping, the panelists, please try turning on your video now. It should work. Excellent.
Right, there we go.
There we go.
That's much better. Thank you, folks. Okay. So that's acquisition criteria. Let's move to deal flow. So first of all, a high level question we ask panelists: which regions have you done deals in? America, Europe, China, other APAC, Middle East and Africa, and South America. Any thoughts on this? Any comments from any of the panelists on this slide? Anything surprise you?
No. I think I'll go here. Nothing surprising in the numbers.
I thought I personally thought that Europe was a little bit higher than I expected. I thought there'd be a bigger gap between the US and Europe. I think probably if we did this 6 months ago, would China have been on the chart? Maybe not. There seems to be a big push maybe in the recent 6 months from aggregators regarding China. Would that be fair?
Yeah, I mean, was it three companies that made an acquisition there?
Yeah, exactly. So on the respondents, clearly some of these questions were sensitive to some of the aggregators, so we don't have full responses to all of the questions, particularly when we get through to valuation. But yeah.
Yep.
Okay, let's move to probably more interesting question. Which categories has your firms done deals in? Arnau, did you have any thoughts here, please?
Yeah, so if we look at the first 3 ones, also here not very surprising. In fact, also the fifth one, I will discuss about personal care, because I think this one is actually quite surprising, in my opinion. But if we focus on the first 3, these are actually like the 3 main categories that have performed really well during the pandemic, with having like founders understanding that they can actually get a good valuation and a great exit, and the market having a lot of activity. And from the aggregator perspective, these are basically like actually very big markets where we can find brands that address the mid-markets, the mid-market segment with basically like decent average selling prices, where they have either evergreen products or products in the early product life cycle where we know that demand will still be strong in the next 3 or 5 years. So not surprising to see these three first one. Personal care, I would have expected to see it lower. I was actually very surprised to see that 60% of the companies have done a deal in personal care. If by personal care we understand like face towels, makeup pads, or sustainable toothbrush, that I will understand, because it's quite a hot category right now that is showing a lot of growth. But if by personal care we understand like kind of like face masks, face creams, or moisturizing or shampoo, that seems surprising to me, because the investment in research and development and also marketing that needs to come to these products are very intense. And I don't know if basically there's a lot of aggregators focusing on that sort of products.
Thank you, Arnau. Would any of the other panelists like to comment on this slide?
I would just say that these are, I mean, if you go through the Amazon's taxonomy of categories, these are extremely broad, high-level categories. So it's actually not surprising to Arnau's comment, right? Personal care could be shampoo to, bobby pins or something like just the extremely broad category. So it's not surprising, and I think these are probably the largest categories on Amazon as well.
Yeah. Okay, let's move to average deal sizes. So we asked respondents to give us a flavor for the average deal size across 4 different time periods. So the sizes were sub $1 million, 1 to 2, 2 to 5, and over 5. And the time periods were to date as a business, the last quarter, the next quarter, and 2022. Trey, what are your insights and thoughts here, please?
Yeah. So as an investor, we obviously favor large and diversified portfolios, and you can get there a few different ways. One is buying a large quantity of smaller assets, and another is buying larger assets that have high SKU diversity. We've historically guided early stage companies acquiring, call it, their first 5 to 10 million of EBITDA, to limit deal size until there was comfort around the underwriting and integration processes. So if they missed, they would miss small, and they could iterate on learnings. That said, there's definitely an argument to be made for acquiring a larger platform asset early on, that has high SKU diversity and the supply chain rails in place that you can leverage across other brands. As you see here in the deck, the average deal size is going up. This makes sense just based on one, aggregator portfolios are reaching scale, and two, the 10 billion plus of capital that's been committed to the strategy. I'd say the key points for larger deals, we like to see, like I said, high SKU diversity, potential for strong brand value, and most importantly, a solid understanding of the target's supply chain and plan for integration, just because larger assets can have super complex supply chains that require the same integration lift as numerous or even a large quantity of smaller brands. With that, I can pass it back to you.
Thanks, Trey. Any other thoughts from the panelists on this slide? Do people think that to get bigger deals, there'll be more off Amazon transactions, or certainly Amazon businesses that have a bigger component of DTC?
It depends. I think to Trey's point, right? I think it depends on where an aggregator is in their life cycle, right? We were very cognizant, 3 years ago. We were kind of getting agita looking at a deal that had 500,000 of EBITDA, and now that's obviously kind of commonplace and probably below our median acquisition at this point. So, we do view it as a portfolio of assets and brands, and with size and scale, you inherently create diversification. So, our deal sizes are increasing, and we actually focus on lesser, tighter product categories and skew businesses than diversified, because we're driving inherent diversification by bringing assets into our portfolio.
Okay, and then Ken, we'll stick with you then as we look ahead in terms of the quantum of deal flow. How is that ramping up at Thrasio and in the industry, in your view?
Yeah, I mean, look, it's a marketplace, right? So there's buyers and there's sellers, and I think what we've seen over the last 12 to 18 months is a massive influx of both. I mean, when we started, again, 3 years ago, it was very evangelical from our standpoint, right? We were educating Amazon sellers that you could actually sell your Amazon business, and they were asking questions like, how do you even do that? I mean, we laugh. We were Googling, how do you buy an Amazon business 3 years ago? There was nothing on the internet about it, right? We talked to brokers, some of the brokers in the industry, they thought we were crazy buying these businesses. And that's obviously changed, right? So you have, a lot of people, aggregators have raised capital, 10 billion has been raised. Everybody's doing outbound reach and identifying, what they deem as desirable targets, doing cold outreach. And that's creating, a buzz in the marketplace, as well as valuations increasing, right? A couple of years ago, it was, valuations were 2 to 3 times EBITDA. They probably doubled now. And that's a real business. That's a real SMB transaction across any category, in the economy. So from a seller standpoint, that's real life-changing value that you can, cash in on create. I would always hear the common refrain was, well, I could just run it for 2 years and make the same amount of money. Obviously got to take into account working capital investment and taxes, et cetera. And that's not really true, but that was the psyche of the seller back then. And now these are real checks, life-changing checks. So I think what you've seen is just a rising tide on both sides, from the buyers and the sellers. And in terms of, I think it's important for people that aren't as familiar with the Amazon ecosystem and the seller ecosystem, just the sheer magnitude of Amazon, right? I mean, that's what has us really excited. Our investors really excited, right? If you look at the third party, gross merchandise volume on Amazon in 2020 was, over $300 billion, right? If you just kind of back of the envelope say, for every $1 billion of capital that's out there to buy Amazon businesses, right? Let's say the average deal is 5x, all right? So that's 200 million of EBITDA. And then the average business is 20% margin, so that you're at, $1 billion of revenue, right? Basically for every $1 billion of capital to be deployed in the market, right? If that 10 billion gets deployed, that's, 3% of the total Amazon GMV, which is growing on an annual basis. So there's a tremendous opportunity ahead of everybody. And it's really going to be, it's no surprise that people are, looking at bigger deals, but operational, infrastructure is probably is the biggest governor in your ability to integrate and digest the businesses, and, manage supply chain is a massive lift. So for people that are looking to do 40, 50 deals a year, there's a lot of investment that needs to go into the organization ahead of that.
Arnau, what are your thoughts of Berlin Brands Group for next year?
We will share a similar thought. I mean, from our side, we're trying to evangelize Europe on this acquisition game, like Thrasio did in the United States. But seeing like a 25% on basically like 40 to 49 deals, that also shows you exactly that. There's a lot of capital in this market. There's a lot of capital, basic capital pressure. And there are more of small aggregators that are coming in the market that are going to focus in basically like smaller deals, while there's basically like the big aggregators that are that will focus in probably less deals, but with a higher EBITDA.
Great. There's a question come in. Is it important for an FBA brand to have DTC potential? Who'd like to answer that?
I mean, I think it depends on the buyer, right? You could argue there actually might not be a lot that have D2C potential, right? It depends on what you view as D2C potential, right? Is it, enhanced branding and the ability to drive off traffic, high converting external traffic back to Amazon and using the D2C as a storefront, as a supplemental, right? Does the product afford attractive D2C economics in terms of LTV to CAC, right? A lot of these products are playing commoditized areas, and if you're not, don't have customer value and brand value, they might not lend themselves to D2C. So I think there's a percentage of all of our acquisitions that do, and there's a percentage that don't. I don't think, I think, value is in the eye of the beholder. So different buyers are going to place different, value on that D2C potential from what we've seen.
And I think we've alluded to it a few different times on this call, but the size of Amazon is massive for any given brand and then in aggregate. So yes, some brands will perform well, sort of like off marketplace, and will have a proper D2C presence, but I wouldn't imagine that it's necessary for people to have successful exits for any of the people on this call.
Okay, great. Okay, so let's move nicely to valuation and deal structures. And we'll try and spend a good bit of time of the call on this section, given valuation is obviously very topical. First question, simple question we asked respondents: did valuations increase in 2021 versus 2020? Trey, what are your thoughts on this, please?
Yeah, as Ken mentioned, no surprises here. Valuations are higher, even double this year versus 2020. Just given the strong growth profile from 2018 through 2021 on, these are high margin businesses. And then also the amount of capital that's been committed to the strategy. And as more investors and more buyers are educated on the asset class, they do understand that these are actual businesses. It's just they're online. And I think the more interesting discussion is on the next slide, where we think valuations are heading. I think we'll see valuations level off after COVID months roll out of LTM periods, and also just supply chain uncertainty. As long as that remains present, I think valuations may level off. It may be a while before they decrease. I don't really see them decreasing anytime soon, but I think given those two factors, we may see some level off.
Yeah, I was surprised how low the increasing piece of the pie was, but then actually reading through some of the qualitative comments that you can see on the left-hand side, that does give lots of food for thought. Ken, any thoughts from you, please?
Yeah, I would echo what Trey said. Look, this is a market that's still in its infancy, right? I think, which is attractive to the aggregators and investors, and it's inefficient, right? And I think what's attractive is inefficient markets give people the opportunity to generate great returns, right? But you need to differentiate based on skill, right? And I think in this market, right, skill is going to be defined by information and analysis that is proprietary, and knowing what you're good at, right? I think there's still a wide probability, of returns per every deal, depending on who buys it. To be quite honest, I always say our first five or our worst five, right? And if the experience is what you get when you didn't get what you wanted. And I think a lot of people are still going through that. And so we were, we had an advantageous position as being, first movers in the market. And, we were financial buyers when we started. Like I said, we were Googling, right? It's no surprise. So we were financial buyers. We've successfully over the last 3 years made a transition to strategic buyers. Right. And then in any M&A market, strategic buyers have an advantage, are willing to, maybe pay a premium for an asset because they know, they kind of, the probability of returns gets truncated based on experience, knowledge, et cetera. So I think there's, a lot of people that are, paying strategic, what I would value as strategic multiples in the market, that are still financial buyers. And so it's no surprise that I think we're going to start to see some shakeout, second rounds of funding not being completed, because if you don't know what you're buying, it's a tough thing to go through. And if you have, as Trey alluded to, if you're buying, kind of peak multiples on, potentially peak earnings on COVID, took pricing, margins, et cetera, that's not going to end well for, some aggregators. We're already starting to see that, quite frankly, in the marketplace.
A question from the audience: how important is EBITDA to the deal flow acquisition price? If we think about all the parameters of valuation, how important is EBITDA?
Yeah, I mean, all deals are valued basically on, I guess, kind of industry standard is based on a multiple of trailing 12 months EBITDA as a starting point, right? Everybody has, I think, their own forward return requirements that they're looking at, and so we use that as a starting point. That's kind of standardized in the market in terms of valuation, but it's really, what is the business going to do going forward, right? I mean, we're not entitled to that EBITDA. Obviously, we assume growth and we underwrite growth, and that's where a lot of the due diligence is focused on from our standpoint.
And more specifically, if the EBITDA growth has been hampered due to lack of financial resources, but everything else is going well and in place, and there's maybe some easy wins if a brand is owned by an aggregator, does the seller get some credit for that?
Yeah, I mean, again, I won't speak for the other panelists, but again, we look at what do we think the business is going to do going forward, not necessarily what has it done historically, right? So that goes into, if you look at a business that had massive COVID growth, right, up 350%, and they're comping down 40% year on year, we're going to have a much different valuation perspective and multiple on that business versus a business that's still trending maybe up 100% year to date on good comps, and they might be smaller, right? So they may have a smaller EBITDA base. Maybe they're generating 200,000 of EBITDA, and we say, hey, we could 1.5, 2x that in 12 months. So we effectively should be willing to pay a higher multiple for that business in that instance. I'll let others comment.
Another question on valuation. Under what circumstances would a multiple of revenue be used for valuation? There was a comment on the right hand side where a respondent was referencing pet deals getting done on a multiple of revenue as opposed to EBITDA or SDE. Any comments on that?
I haven't seen a lot of evaluations done on revenue. To be honest, the only scenario where I would see evaluation done on revenue is basically if there's the EBITDA is negative or there's really no profit, but basically we're acting more as a risk taker, and then we know with our synergies we can make it profitable. So that's the only scenario, but it's from what I see in the industry, and again, I also don't want to talk for the other panelists. I haven't seen it so far in the Amazon acquisition game.
I agree with that. I think classically you might value on revenue for a high recurring base, like in a SaaS style business, which might have some analogs in e-commerce, but they're less common.
Yeah, they'd be on the, if you had a heavy D2C component and you had a very proven D2C, LTV to CAC ratio and long runway, then the revenue. But if you're not profitable on a unit economics basis on Amazon, I think you're gonna have a hard time selling your business.
Do you all think that sellers are generally aware of the market multiples being paid?
Probably now. I think it was black box for a while, but it's pretty, I think, common. I mean, there's a lot of transactions that have taken place over the past, right? I mean, that's one of the great things about this ecosystem is it's full of entrepreneurial minded individuals that are in groups together. They have meetups. It's very collegial and kind of fraternal order, if you will. And so, if you're a high volume seller, my guess is you have friends that are also high volume sellers, and a certain percentage of those have either exited or are having discussions around exits. So, I mean, that's kind of my assumption, but.
Great.
I think that's right. And there's been a lot of, commentary that you can find about how things have traded, but there's kind of an interesting lag to what we might see in real time when you're really hands on the market. And so that gap in understanding is kind of an important one probably to appreciate is, the market will move and you won't be able to see it because it's not a sort of like public market until later on. So some of the things we look forward into the future here, and half of the aggregators saying multiples will decrease if everybody comes into next year, assuming that they're going to continue to be at elevated levels. If that ends up being true, there might be sort of a lag in people's information feedback loops.
And that's certainly an area where the Fortia group is seeking to help both sides. So there are more questions on valuation, but hopefully if we have time at the end, we'll come back to those. We might want to make sure that we can get through the other section. So yeah, I really enjoyed asking these questions. Unfortunately, we didn't get as many responses as we would have liked. People were sensitive to this information, but nevertheless, we asked which categories are seeing increases in valuation. Brendan, would you like to comment on this one?
I mean, some of these I've definitely seen personally. I've seen things trade at really healthy multiples in pet care in particular. My view here is that it matters so much the quality of the brand within the category. To Ken's point earlier, like you think about kind of the breadth and scale of any of these categories and the sort of diversity of business quality that you might find in any of them. I think there are, in my mind, if I'm thinking about sort of setting value on a business, it matters much less the category that it's in than other business features like its growth profile and margin profile and kind of quality of the brand and product and the sort of competitive nature of its market. Ultimately, that it rolls up into one of these buckets is a latter concern.
Anyone else want to comment on this? No. Okay, let's move on.
No, I mean, just it's valuations are rising in the market, so these are the biggest categories from the previous slide, so it's a surprise.
Yeah. Okay. So in terms of deal structures, we asked the the survey respondents, what percentage of your deals are upfront versus deferred? Maybe Trey, do you have any thoughts on this as an investor?
Yeah, this is pretty in line with what we're seeing just across the board. We've seen more and more creative deal structures as the asset class becomes more and more developed. But I think the main theme is that sellers are now more willing to share some of the post-acquisition risk and also participate in the post-acquisition upside through earnout structures, just given the proven track record of post-acquisition growth that a lot of these aggregators are demonstrating. And we can speak more to that later. I think there's another slide later on post-acquisition performance.
Thanks, Trey. Brendan? Yeah, I would agree. I think this is right. There are, some risks that Trey alluded to earlier that are kind of going to find themselves into people's operating performance in the coming maybe 12 months on sort of, COVID kind of rolling off and challenges with freight costs and sort of margin compression due to other sort of cost structure concerns. So those are concerns that sellers will face, that buyers will understand well, and that we can certainly navigate through, but figuring out together sort of how to share that risk and the upside for being part of a bigger platform, I think is something that lends itself to, I don't know that it's particularly like creative structures, but just potentially more structured to share that risk rather than all upfront payments, which you might have seen more recently.
Very good. So let's move to the next section, which is performance of brands post-acquisition. There's two questions we asked here. The first is we asked respondents, what are the key levers for improving the performance of brands post-acquisition? We offered 5 and had another category. So number 1, optimization of brand seems to be the winning lever, then optimization of supply chain. What are people's thoughts on this?
Yeah. So, I mean, we tend to look at opportunities as, assessing ease and impact, right? And if you look down this list, it's basically the easiest. It's ranked basically in order of ease. I mean, retooling a supply chain is not an easy lift. I can tell you, particularly with the backdrop we're in today, right? Kind of post-acquisition, you're digesting the business, everything, right? I mean, with every acquisition, you're taking in anywhere from 3 to 10 different new supplier relationships and engagements, right? And you just want to make sure there's continuity before you really start looking into how to really optimize that. And everybody's chasing inventory and just dealing with that. So, and opening up the business to immediate disruption is not the best interest of either the buyer or the seller. So I think, optimization of, listings, keyword rank, PPC is a quick, easy wins are often found there. And then as you go down, right, launching product launch is not easy. It takes time. Launching D2C sites. I mean, all these things are, need to be planned and orchestrated internally. So it's really no surprise that they're in this order. There are a lot of opportunities. I think this is, one of the key underlining theses is that this is, it's the professionalism of Amazon sellers and brands is what's required moving forward to be successful because of issues, around supply chain and advertising costs going up, and really understanding how to be excellent in each one of these areas is what's going to separate Amazon sellers in the future.
Brendan, Arnau, any comments on this?
I think I would agree with everything that Ken said. I think basically from a European perspective, launching on more Amazon marketplaces, it's much easier for us, right, rather than being done a US aggregator. But I think I would agree with the Ken analysis.
We view some of these things as sort of, I don't know, administrative or a sufficient size organization can take on some of these challenges while an individual seller may not be able to. I'm always really impressed with how sellers solve these challenges and understand their inventory positions and supply chains, but it's usually in a Google sheet or something like that. Whereas, when you build a sort of proper sort of suite of tools and technologies to solve these problems that are just leverageable in really interesting ways. I actually think the marriage of the first 2 points, understanding kind of your inventory positions and locations of inventory, and then your sort of marketing, advertising, pricing strategies on the front end, sort of sales channel side, that dance that those 2 sides of the business do is kind of a challenging one and a sort of big, a data problem that, maybe bigger companies who kind of build for this correctly are well positioned to solve for in a way that smaller sellers just won't have kind of the same throughput of data analysis.
Yeah, agreed. Okay, so if they're the levers, then what's the resulting performance? We asked respondents what was their average net contribution margin of acquisitions in the first 12 months post each acquisition, and you can see the distribution here. Trey, maybe back to you as an investor. What are your thoughts on this, please?
Yeah, as an investor, we obviously love growth, and this jives. From the last slide, there's a bunch of quick wins, and beyond that, there's a robust suite of other growth levers that these aggregators can pull, given their scale. But I think this is a super important slide for sellers. If I'm a seller and I'm seeing this, then I want to participate in this upside. If an aggregator can show me its proven track record of post-acquisition growth, I would definitely want to defer a portion of my payout to an earnout. I mean, even as a professional investor, it's tough to find areas to compound capital 30% plus. So I think this is an important slide for sellers.
Thanks, Trey. Any of the aggregators like to comment on this one?
Yeah, I'd like to just add a very quick comment, but it's very important now that we also we educate sellers on basically the capacity of basically generate growth, right? And that we show them proven winning business cases, so we can actually defer part of basically the valuation to an earn up or profit share scheme.
Great. Okay, so let's move on to look at the future, and then we'll open up to audience Q&A. So we asked the respondents to give us their predictions. Their top 10 predictions is what we put forward here today in the webinar. some of these will be no, and hopefully some won't. You've heard a few times during today's webinar that aggregators may get into financial difficulties as we get into next year. The consolidators will get consolidated is a sort of a tagline that's been mentioned over the last year or so. Focus on outperformance. Focus on the operators. Ultimately, will be the winners as opposed to the M&A guys or the financial guys, and lots more. So what I'd like to do is ask each of the panelists to maybe pick one that's either on the page here or doesn't have to be. What's your top prediction as we look ahead to 2022? Maybe I'll start with Brendan, please.
Yeah, I mean, it's always hard to know sort of what's going to happen here in the space. It's hard to kind of be inside other people's boardrooms and understand kind of how they're performing and how they're kind of dealing with the challenges that they have. The one thing that I'll say, and I guess it's related to sort of number one and number three in some ways, and probably sort of feeds into some of the others. I have an enormous amount of respect for what sellers, what people who build these companies on Amazon are able to do. It's like really challenging to run businesses in this ecosystem, and that's not lost on sort of us as operators. I like what Ken said about kind of being strategic buyers, and you've got to build good teams and really interesting kind of tools and technology and process to be able to do this well, and especially to do it at scale. And so it doesn't surprise me that I don't know, I feel like I have the easy job of buying the companies. I think kind of running them ends up being the hard part. And we focus so much on building out that ecosystem, on doing that well, on sort of taking the level of kind of operating pride in our brands that a founder would. And it's the only way for us to be successful. And then also importantly, kind of adding to our portfolio and to our brand family at the right pace that matches kind of our capabilities, which I think it would be easy to sort of get out over your skis in some ways against your operating capabilities. And so that those sort of misstepping in those ways would lend itself to kind of underperformance and not being great operators, and ultimately to having challenges with capital raises and otherwise. Doesn't surprise me, sort of knowing how difficult it is. I can see that happening to some people, and you just got to be focused on kind of the right things. So that's probably likely to happen, and hopefully sort of we're focused in the right areas where we can kind of execute on our understanding of how best to do this in a way that allows us to succeed.
Excellent, thank you, Brendan. Ken?
Yeah, I mean, I would echo everything Brendan said. D2C, I'm skeptical on that. I know there's people that are starting to roll up D2C brands as well, kind of running the Amazon aggregator playbook. I think they're very, very different business models. I could see, if I was going to do a D2C startup, I would focus around the end consumer in the category and being able to leverage that customer. Right. So if it was like home and kitchen, right, and you aggregate, specific brands that you could penetrate that, one customer and leverage that, I think that could be a successful model. I also think that 9, if I was starting up today, I'd have a very unique focus. And again, back to, 9, I'd marry 9 and 5. So if I was starting an aggregator today, I'd focus on a very specific niche where I am a strategic buyer day one because of past experience and know-how. I think that would be a successful strategy as well. You just have a smaller, broader TAM that you could go after, but I think that could be very successful, right? So you're willing to pay premium over anyone else in the market because your level of confidence on execution is that much higher than everybody else in the market within a specific category. So I think you'll start to see that. We're already starting to see it even from existing aggregators really, focusing in a little bit more on specific categories or end markets. But 1, 2, a lot of these are all like basically daisy chained, I think, right? It's like cost of capital, whoever has the lowest cost of capital is the best operator. Those are the ones that are going to succeed. The ones that are on the other side of that ledger are the ones that are going to fail, and they'll be bought by, the ones that have the lowest cost of capital, et cetera. And I think be the spiral. I mean, most markets, if you look historically, across business, consolidate around 5 to 8 players. This is a massive market. It's not a winner takes all by any means. So, I mean, maybe there's 5, 8, 10 over the next few years. I think that really shake out and kind of go the distance. I think a lot of it is just if you're a capital provider, right, and you have the opportunity to invest in, one of those breakout leaders and operators, you're better served allocating capital there than somebody who doesn't have a track record. So,
excellent, thank you, Ken. Arnau.
Yeah, I will also. I was very interested to see number 5 here. More strategic buyers will enter the space, and I will marry it with Nan as well, because in the recent months, what we have seen, and because basically the aggregators have done a lot of noise in the press, and we've been mentioned, and there's a lot of capital that have been raised. There's a lot of businessmen having their own business that have been interested in what we're doing, and they're basically now even them considering and buying Amazon business or e-commerce business. And so it's now very common that sometimes when we are basically negotiating a deal when we are in a competitive process, that we will have like the usual aggregators, but that's normal. But we're seeing appearing like an Amazon competitor that knows them really well and wants to acquire them. Or we're going to have like a retail company in Europe or North America that wants to gain exposure on e-commerce and will also be interested in them. So it looks like we're going to have like also new players coming in next year.
Yeah, very interesting. Thanks, Arnau. And Trey?
Yeah, I think all of us here believe in the broader e-commerce secular trend. So in my opinion, it really comes down to capital and certainty of capital over the next handful of quarters, where there will be continued supply chain delays and higher costs on the product side and shipping side, and also cost of customer acquisition and advertising. I think overinvestment in inventory will be key. So as everyone knows, or most of you know, like stocking out of inventory can be catastrophic for a listing. So I think we're going to see the sellers and the aggregators that can overinvest in inventory separate from those that cannot. And as they separate, they'll be able to also invest in building the listing value with more expensive advertising spend. They'll be able to expand to other marketplaces and expand internationally, and it'll further stratify the marketplace or the ecosystem. I think that ties into 1, 3, potentially 2. Yeah, I think those are the main ones.
Excellent. Thank you, Trey. So we have 5 minutes left for Q&A. If I go back and look at submitted questions, how do valuations vary by geography? Anyone want to take a stab at that one?
I mean, I think they're pretty much similar across the board, in my opinion. I don't know, Arnau. I mean, Europe, it was funny. I thought Europe was a little bit higher than the US 6 to 12 months ago, but the US has caught up.
No, I would say it's similar. In fact, I would even say that in Europe it's a little bit lower than North America, but it's pretty even across.
Yeah, it's pretty
even. As a seller, how should one evaluate the right aggregator to go to?
I want to make sure they can actually close the deal. That's number one, right? I mean, we're hearing a lot of sellers that are come to us and say, yeah, there's a lot of people that are just signing term sheets that don't either have the capital, they're shopping the term sheets to raise capital against it. They actually don't know how to, transact and take over an Amazon business. So, experience of the buyer is really important in making sure they have the capital on their balance sheet to actually execute on it. And then depending on the deal structure, you know, Brennan alluded to it on the, you know, 30% of, you know, payments are deferred. You know, again, 3 years ago when we were pitching this deal structure, sellers were asking if we're going to be around in 2 years. And I, you know, I couldn't sit there with a straight face and say, absolutely. I was like, yeah, it's a great question. You know, that's a risk, I think, for the top aggregators to raise a lot of capital. You know, are they going to be around in 2 years to hit those performance payments and pay them out? I mean, that's a real question you should be asking if you're a seller, unless you just you know, depends on what you value as well in that deal structure, right? I think people are trying to win term sheets by offering a high upfront value in a race to deploy the capital, but again, make sure that they can actually execute on it, because I can tell you what happens is now then you come around again, and everybody that, you know, lost, you know, either lost out on the bid or felt like they hit the high end of their valuation for your business, if you kind of come back to them hat in hand, that also you know, can put you in a worse off negotiating position as well. So you got to do your homework, just like, you know, the buyers do.
Yeah.
Personally, I think it's crazy how quickly some Amazon entrepreneurs sign LOIs within 1 or 2 days of meeting the first buyer. I think that's a bit crazy. I need to speak to multiple aggregators to get the right deal.
Yeah, and I would say it's not a bad thing if like the potential buyer is asking a lot of questions early on. Like the more they know going into the LOI, the more comfortable you have on sort of certainty to close. So people who know what they're doing will know the information that they need to sort of have, you know, most of their evaluation far down the path. Things always come up in diligence. You want people who kind of have a reputation for being flexible and sort of, you know, working through problems together with the sellers. But ultimately, if somebody just sort of, you know, sees your pitch deck and gives you an offer, you've just got to question, you know, how well do they understand it before signing into not just a 30-day or however long of exclusivity, but a lot of effort that goes into coordinating your diligence process. You don't want to waste that time. You want to, you know, do it with somebody who's going to buy the company.
We've run out of time. Thank you so much to each of the panelists, to Brendan, Ken, Arnau, and Trey. Really appreciate your contributions to today's webinar. As a reminder, a recording will be available via the fortiagroup.com website in the coming days. If anyone has any questions, please email exits@the4tiagroup or email me direct at emmett.kilduff@the4tiagroup. Otherwise, thank you all for your time. Have a lovely day.
Thanks, Emmett.
Cheers.
Thank you.
Thank you.
Take care, everybody.